we tend to kind of gravitate towards folks who kind of already have a business sort of up and running, but in venture capital in particular, I mean, everyone knows the statistics of, the percentage of black female founders in particular they're atrocious. And so I think there has to be a balance between, working with folks that you've seen have success before and finding other more nuanced ways to really get to know a founder who you may not have known before to really understand what they're capable of.
This is where it all begins, so say goodbye to all your fears, all your doubts. This is where they die. This is where we come to win, we come to fly. This is where we make our dreams come to life. Welcome to Innovation City.
Welcome to Innovation City, a podcast featuring the innovators, disruptors, and creators who are changing the way that business happens. My name is Tyler Kelly. I'm here with my co-host Leigh-Ann Buchanan, and we're coming to you from Slam Agency St. Louis. And we're super excited today because we are joined by Austin Woods.
Nice to meet you guys.
Welcome.
Happy to be here.
Welcome to the show, Austin. We're going to talk a little bit about your bio in a second, but I love to just do a quick intro and get started into who you are. So for those that don't know you, you are an analyst with Lewis & Clark Ventures. And what I love about your firm is it's really hyper-focused on the middle. So that the idea is that there's innovation happening between the coasts, so not just on the West Coast, not just on the East Coast, but right here in the center. And then you do a lot of work around providing some insights, data, and kind of analytics on the innovation and the scale-ups and the startups that are kind of launching here in the middle of America. So that's about you. But I want to know, what are you most passionate about?
The middle, like you said. I guess a little bit of background. So I grew up in rural Kentucky, kind of middle of nowhere. I think when you grow up in communities like that, you think of success as being, I'm going to go to medical school or law school, but those things didn't really appeal to me that much, which was a disappointment to my parents, maybe still is. And so I actually thought I wanted to still go down sort of like a more traditional path, I guess you could say, and go and get my PhD in economics. But the things I was really interested in at that time were looking at areas like education and figuring out, what are the types of business models that we could change in education to really unleash, better academic and other social outcomes for different classes of people. I was interested in the economics of crime. What are different approaches to policing or the legal system that we could make to sort of change those sorts of outcomes? And also startup activity was another one. So I was really interested in the factors that lead, different regions or different types of people to be able to successfully kind of launch businesses and create like real economic value. Unfortunately, I realized I had very little interest in academia about 6 months into the program, but I was still really interested in those areas. And so I spent a lot of time thinking about, how I could get more like boots on the ground exposure to solving those problems and kind of meeting the people that are thinking about those problems in interesting ways. And so entrepreneurship was sort of kind of out of left field for me, but it was the direction I ended up kind of going. So towards the end of my time, actually at WashU here in St. Louis in the econ program, I started working with a group that was getting up and running called Launch Code. So interesting St. Louis and, well, I guess formerly Miami connection. But so I kind of was there very, very early on and kind of helped the organization build up our technical apprenticeship programs and our computer science and education programs, things like that. And really, I think that scratched the itch I had on the education side of things, thinking about, the future of education and credentialing kind of a more, progressive way. So I spent a few years doing that, had a great time, and then kind of decided I wanted to diversify and get exposure to different types of interesting businesses in the middle of the country in particular. And that's what led me to Lewis & Clark Ventures about 3 years ago now. So I've been working with startups kind of peppered all throughout the middle of the country ever since.
And one of the things you do at your firm is you publish a weekly newsletter as well as an annual report. Talk to us a little bit about those publications and maybe some of the top takeaways or insights that have come out in the last year or so.
Yeah, sure. So I will start with the report because that that predated the newsletter, but very excited to talk about the newsletter as well. So the first Between the Coast report was actually published just before I started. Someone else at the fund had kind of taken a more kind of one-time academic approach to it. It was, very, very numbers heavy, and it was great. A little bit less approachable for maybe, your common audience. So when I came in, I wanted to kind of tweak the format of that report a little bit and really kind of focus on 3 key areas. So that's deals, funds, and exits, which is, typically an acquisition, could be an IPO, something like that. Because those are kind of the 3 main metrics when you think about the health of, a tech ecosystem that you really think about. The deals that are being done there, the funds that are leading those deals, and then when they come together and create, an endpoint, hopefully a successful outcome for the business. And so I spent some time thinking about, how to present that data. And basically, those were the 3 aspects that we ended up with. So it's interesting when you look at the trends. We typically will look at maybe the past 6 or 7 years or so and compare the trends over that time. You see some positives and some negatives. So we do consistently see a pretty good uptick for the number of deals in what we call the Between the Coast region, which is basically everything from Nevada over to West Virginia. So we see the region from both, a number of deals and a dollar value of deals, kind of steadily increasing over time, which is good. Pace isn't great. It could definitely be faster, but, the number of deals are increasing. The number of funds, kind of not so much. And I think that's one of the things that is difficult, particularly when you think about the early stages of a company. It's much harder when you're, building a business in Missouri or Utah to get early stage kind of very what you might call smart funding from the coast, because they're not spending a lot of time in those ecosystems. It's really difficult to build those relationships. And so I think the number of funds is definitely something that I think is a problem, and we need to make a significant improvement on, not just at the extremely early stages. I feel like ecosystems like St. Louis have, they've kind of got the accelerator side of things covered, and we've got a lot of very helpful angel groups. And I think that goes for most of the ecosystems in the middle of the country. But when you really get to that, core institutional, like Series A funder, that's really where a lot of these ecosystems lag behind. And then kind of the third point I'll make, which I think is one of the most interesting ones, given the challenges that I alluded to earlier, when you look at exits and you compare, the value of the exit to the capital that went into the business, Between the Coast firms actually in almost every year since 2010 perform better. So there are better exit multiples. We're kind of more efficient with our capital. So we achieve, smaller exits, but we achieve it on much, much, much less capital. And so I think that's due to a number of reasons that we might get into, the lower cost of living in the middle of the country, kind of maybe more, I don't want to say conservative, but more kind of thoughtful, realistic business models. But we're kind of still exiting for, roughly the same amounts that coastal startups are able to exit for after going through, much more capital. So I think that's a good story, both for investors and their returns, as well as for entrepreneurs who are not being diluted as much. And therefore they're having, their cut of that pie is bigger as well.
I think that's an interesting incentive when you're talking about attracting more firms to the middle, is that the ROI is actually going to be better on both sides.
Yep.
And also thinking about the support ecosystem and the scaffolding around growing and scaling ventures, which isn't always the case on some of the coastal areas. It's kind of like arbitrage versus having some infrastructure around scaling up companies. Right.
Yeah. And I think the approach in general with Between the Coast funds is much more, I think, collaborative in general. The sort of stereotypical big coastal fund, their approach is kind of the spray and pray model, right? You pick a lot of different companies, you plow a ton of capital into them, often, first time founders who haven't really had to figure out what to do with $20 or $30 million before in a, year-old company. And then, you kind of just see what makes it and what doesn't, and that's that. I think middle of the country investors are a little bit more, not only are we typically writing smaller checks, but we're helping our entrepreneurs kind of be smart about how they use that money, drawing from our experiences and experiences of, our trusted folks in our network.
You would think, just being in our, our digital world, that the distance between, a fund in San Francisco and a company in, St. Louis or Kansas City or something, it wouldn't be that much, but you're telling me that it is.
Yeah, I think there's definitely been a little bit of a shift even in the past 3 years. I think, as obviously we're not traveling a ton at the moment, but whenever I've been to conferences in Chicago or Denver or Kansas City, there's definitely more folks from the coast than there used to be at kind of the Series A and B stage. However, it's sort of like they're kind of there craning their neck around trying to figure out what's going on. You still don't see much coastal activity at the Series A stage, maybe at the B, but there's not a ton. Now that may be changing if kind of the current trends we're seeing for increased remote work, both for employees at startups as well as how deals are sourced changes. We may see some of that, but definitely the standard even just 2 or 3 years ago, that sort of a joke, but it's actually true, that you hear from startups raising funds on the West Coast and the Valley in particular was, if I can't drive to your office in 20 minutes, we're not interested, which is kind of a much different approach than what we have.
Does this kind of hit at, it's not what you know, but who you know, and that it's really a relationship business in terms of like Series A investing?
Yeah, I think that's probably unfortunately true across the board still, even in the middle of the country. I mean, venture capital and fundraising in general is definitely a game of relationships. But I think it's, there are pros and cons to that, right? Like it's a lot easier to back a founder that you have a relationship with, and you've seen what they've been able to do in the past. At the same time, that sort of solidifies some of the long-held biases that we have in venture capital and the economy and society generally, but in venture capital in particular. I mean, everyone knows the statistics of, the percentage of black female founders in particular they're atrocious. And so I think there has to be a balance between, working with folks that you've seen have success before and finding other more sort of nuanced ways to really get to know a founder who you may not have known before, to really understand what they're capable of and kind of think about that in a non-traditional way.
So I'm curious about that point that I want to kind of drill in on a little bit. Statistics, as you mentioned, are absolutely atrocious, particularly, for Latina and Black women founders. I think it's 0.002% of VC tech funding actually goes to those groups. And you hit on an interesting point that a lot of VCs are not talking about, which is we all know it's a game of social capital. We don't want to say it, but that's the reality. And I've always thought that if we can create spaces where VCs can build trust and get access to maybe underrepresented founders of color, LGBTQ founders, and people that are maybe on the other side of a line of difference than the majority, then that's where you'll actually be able to see some inroads to opportunity. What are some ways that you are thinking about or even trying to get connected with founders that wouldn't naturally come across your desk within your traditional circle of deal flow and deal referral?
Yeah. It's not easy. But I know one thing I personally do, there's an organization in town called We Power that I work with a little bit, because I think some of the work they do is really important. I think all of it is, but the piece that I am kind of most engaged with, just by nature of my background and experiences, is kind of building that pipeline at the front. It's really difficult because there's such an education gap just about like what it means to raise capital, what the different sources of capital are. It's difficult to fix the problem at the stage we invest without kind of going downstream and helping educate founders and teach them, what a pitch deck should look like and, what it is that investors are looking for. There's just such a lack of education there, because I think we tend to kind of gravitate towards folks who kind of already have a business sort of up and running when we think about what our entrepreneurial support ecosystem looks like. But you really have to go before then. You have to look at, the solo entrepreneurs who are kind of doing this for the first time, help them understand, the pros and cons of different approaches to building a business, and just sort of, how to do it. It's not easy, and we don't do a good job anywhere of teaching that. But I think just due to history, I think, underrepresented groups are particularly hurt by that. So that's something that I try to devote some time to every couple months. I think one other thing that I think the St. Louis ecosystem does a decent job at, everyone could improve obviously, are just sort of the informal meetups, whether that's meetups for founders of color or for LGBT founders and entrepreneurs, or LGBT coding meetups. There's a number of different, approaches that you can take there, and they're all great. But just kind of getting folks together who really feel kind of isolated and like they're alone on that journey, because everyone they see whenever they are, going to, an investor's office is, an older straight white man. So I think that sense of community is really important. And so we try to do, things to foster that as well.
It's interesting that you mentioned this idea of community. One of the kind of phrases that we often say is isolation is the enemy of innovation, because innovation can't thrive in a vacuum. It actually requires this social kind of process of talking and sharing ideas and getting feedback. How do you, and I'm probably pushing you a little bit on this one, but I love to talk to VCs. I've heard a story recently about kind of a traditional white male VC was at an office building and was kind of telling these founders who actually owned office buildings that they didn't belong there. Yep. What are some of the ways that we collectively, not kind of putting the onus on you, but ways that we collectively can do a better job of creating a sense of belonging and acceptance and openness for those types of founders that are underrepresented? Because, that social media battle back and forth, someone said, well, imagine what it looks like when they walk in to pitch for funding.
Absolutely. Yeah. I saw that video yesterday and it's awful. It also happened to be I think it was in Minneapolis as well, wasn't it? Yeah. It's, so I think from an existing VC perspective and just even founders and entrepreneurs, I think something that's really important is to call that out. I think there's still too much of kind of the old boys mentality among a lot of VCs. And so I think it's really important that people make it clear, that's not okay. And it's not just something that you kind of talk about in your partner meetings, like, oh yeah, that we really shouldn't be supporting that kind of thing. It's like, no, you need to say that. And whenever you're at networking events, I've never met that particular individual. But if I were at an event in Minneapolis, I think it's important, you're building a deal, a cohort or something with other investors, and you see, someone who has, a track record that of like that, you say, I'm not doing this deal with you. And you let the founder know, like, you shouldn't be working with this investor. We really need, there are some pros and cons to public shaming, but I think that in cases like these, it's necessary. And then another thing that I think I know we've done internally when it comes to issuing our term sheets and our deal docs, are putting in certain clauses that we kind of took a moment to think about what terms we had in those docs, particularly when the Me Too moment came forward, that we took that as a moment to think about, whether or not we needed to be a little bit more progressive with how we were thinking about those things. And obviously we did. So in that context, it was adding, sexual harassment policies and kind of offering a playbook to our new companies around sexual harassment. But I think alongside that, sort of mandating to your portfolio companies certain language in their employee handbooks around other types of discrimination is important as well, and something that we're definitely thinking about.
I really appreciate the progressive kind of approach that your firm and that you guys are taking, because a lot of times the tendency is to kind of sit back and say, well, it's not really our role, but it's really positive to see like a VC saying, no, if you're in our portfolio, this is kind of what we stand for. So there's got to be an alignment of values. Right. So I appreciate that.
So for the, founder that's listening or watching right now, what are some of the things that are just must-haves, and then what are some nice-to-haves when it comes to obtaining, what's the VC looking for in order to give out that funding?
Just from a general business perspective? Yeah, I think it depends on the stage, obviously. So I'll maybe speak more to the stage we invest at, which is, Series A, typically a $2 to $4 million first check. So we like to think of the threshold at which we get interested as product market fit. A lot of VCs will have, you need to have $1 million of annual recurring revenue for a SaaS business or something like that. We don't really have hard and fast numbers that we think about. It's more that we want to be taking on more execution risk rather than kind of product risk. Obviously, any business at any stage is going to have all of those things, but we want to weight our risk more towards executing on a product that you've already kind of demonstrated has fit with your customer base. So one example I use, we've invested in a company that had, I want to say maybe $50,000 of annual recurring revenue. It's one of the earlier deals that we did, but by talking to customers and really reviewing their financials, we were, we became comfortable with the fact that they were really serving this pain point in the market. It was just very early in the company's life. On the flip side, we've passed on tons of deals for companies that have, $3 million of recurring revenue, because when you dig in, it's, all concentrated with one customer, or everything that's being sold is sort of a custom build. There's not really a defined use case. There's not a repeatable sales motion. So those are some of the red flags, for us. And then the other thing, which is a little bit more squishy, I think, is just founder fit. And I mean that in the context of, a founder kind of fitting the business they're in, as well as the founder, fitting with us, if that makes sense. So, when it's kind of a trite cliche at this time, but a lot of VCs talk about, investing in an early stage company as being more like a marriage than just a business relationship, because you're kind of in it for the long haul. I mean, I think probably the average hold period for an early stage investment is probably longer than the average marriage in the United States. So you really have to be comfortable. And that's everything from just getting to know the founder on a deep kind of personal level. We always try to spend time really getting to know in an informal setting our founders, and meet their partner or their kids, or just really get comfortable being around them and kind of build a relationship where they feel comfortable calling us anytime to talk about how excited they are about a new contract, or complain about something that went wrong and seek our counsel. We really want to be that sort of relationship, as opposed to the type of investor that you're just throwing together a bunch of reports for right before a board meeting. Yeah.
Good stuff. You know what time it is? It's time for the lightning round.
Half the deck, and I'll take half the deck. There you go.
Oh, there's cards.
There's cards.
Yes. What are you working towards that you could use help with right now?
Ooh. How much time do I have to answer these questions? We didn't cover the ground rules, but
of course an analyst is going to say, how much time do I have? 60, 45, 60
yeah,
seconds.
well, actually, I will answer that question by promoting something I forgot to earlier. So the Between the Coast newsletter that I started actually about a year ago at this point. It's a newsletter I put together on behalf of the fund every week. It's sort of a combination of a deal digest where I break down all the kind of recently announced new fundraises, new funds, new exits, as well as content that we at the fund think is particularly relevant or helpful for entrepreneurs or investors, or just folks generally interested in innovation in the middle of the country. So I'm always looking for, new deals, new exits, new funds to include in the newsletter, as well as cool articles or content that folks see. And events too. I promote those, although events are kind of in a weird spot right now. But yeah.
And subscribers, I would bet.
And subscribers,
so
yeah.
We'll definitely put that in the show notes.
Always need help up in the subscriber count.
I think that's the next one I'm going to subscribe to. Ooh, this is fun. What question would you ask a fortune teller?
Ooh. At this moment in time, probably what will the economy look like 12 months from now? I mean, that's kind of a joke answer, but not really. Actually, no. I think that's what I'm going to stick with. Yeah, that would be very helpful information for a number of reasons right now.
What do you spend too much time doing?
Oof. At the moment, my very transparent answer is playing Animal Crossing.
What is that?
The best-selling Nintendo Switch game of all time that came out during quarantine, and I think it's helped a lot of people through it. It's a great escape. I'm just going to leave it at that.
I would say mine is Netflix. Binge
That
watching
too.
shows that okay, very vulnerable. But like I binged watched Gossip Girl, which I watched when it originally came out. And so I can definitely say TV.
Yeah.
TV time.
That goes for a lot of us these days.
I've been doing Nintendo Switch too. And just a little rabbit trail. You told me about CBS All Access, right? For Star Trek, for Picard.
Oh, yeah.
If you're a Trekkie, Picard.
I aspire to be a Trekkie, but I'm not at the moment.
But here's the thing. I watched all of Picard. This is a true rabbit trail. And then, do you remember that show with The Good Wife?
Yeah.
So they have like The Good Fight on CBS All Access. And like I'm all the way through like 4.5 seasons.
Good for you.
Yeah, it's pretty good. I was a big Good Wife fan, by the way. Yeah.
So what random act of kindness could you perform right now?
I think something that I strive to do is be helpful to folks whenever I can't kind of immediately help them out directly, if that makes sense. So, as a VC at a Series A stage fund, we talk to a lot of entrepreneurs who are kind of much earlier than we are, or it's very clear, they're building a cool business, but either it's, not going to be a venture backable business, or it's just not going to be a fit for our fund for a very long time. And so I always try to actually deliver on the thing that VCs always say, which is how can I be helpful? But I actually do try to think about who could I introduce this person to, or, tell them, send me your pitch deck. I'll do a quick review of it, things like that. Because I think, first of all, the sort of cynical, so not kindness way to answer that question is you never know when that's going to come back around and that's going to be beneficial to the fund. But I also think it's just, as someone interested in really promoting entrepreneurship in, historically not places that aren't centers of entrepreneurship, I think I just kind of like doing it.
That's great.
All right, last question. What risk are you happy that you took?
Oof. I would go back to the beginning of the conversation and say when I decided to leave the program, the economics program, it was a very tough decision. It was a kind of a very rapid lifestyle change from going to, being a teaching assistant and running models in MATLAB all day in the computer lab until 3 a.m. to, putting out every possible fire that you could imagine at an early stage company. And then, but I think it was a great decision. I kind of looked at that as maybe initially as an overcorrection, trying to get out of the stodgy world of academia. And I just ran to startups because what could be more different? But I think it's been an amazing fit, and it's been incredibly worthwhile so far. And I intend on kind of staying in this world, be it as an operator or an investor, for the foreseeable future. So it was definitely risky at the time, but I'm glad I did it.
I guess the worst risks are the ones you don't take. So
that's true.
Thank you so much for joining us. I really enjoyed this conversation.
This has been awesome. Before you go,
awesome.
tell us how we, the viewers, can get in touch with you online, can subscribe to the newsletter, all that good stuff.
Yeah. So the newsletter is called the Tech Between the Coasts newsletter. You can subscribe on our website, lewisandclarkventures.com. Also, I'll share my email address. It's just austin@lacventures.com. Always happy to talk, whether you're an entrepreneur, someone just interested in tech, whatever. So you can email me directly there. And I tweet at Austin Woodsy. So that's just first, last name with a Y at the end.
Excellent.
Awesome. Austin, thank you.
Yeah.
Thank you.
Thank you, guys.
Thank you for listening to Innovation City. If you like this episode, you can find more episodes at innovationcity.co or anywhere where you watch or listen to podcasts. Please subscribe, rate, and review, and we'll see you next week.
This is where it all begins, so say goodbye to all your fears, all your doubts. This is where they die. This is where we come to win, we come to fly. This is where we make our dreams